Sadly, inflation won't be going down anytime soon, and as a result, high interest rates are here to stay. This is expressed rather clearly in the following chart. What you're looking at here is the M1 U.S. money supply. The M1 money supply refers to all cash and checkable deposits in our country. Since the beginning of the COVID pandemic in 2020, the U.S. has printed nearly 80% of all U.S. dollars in circulation. Let me put this into perspective for you. At the start of 2020, we had a meager $4 trillion in circulation. Now there is a mind-boggling $19 trillion in circulation. That's a 375% jump in a mere 3 years. So one of the worst calls the Fed could have made at the beginning of the inflationary period was to predict that the spike in inflation would be transitory. Transitory is just another way of saying it's a temporary blip. The thought was they'd raise interest rates briefly as a way of tamping down inflation and then lower them again once inflation subsided. Well, when you have massive amounts of money sloshing around in the economy, that's the perfect recipe for inflation. And unfortunately, there aren't any quick and dirty ways to neutralize it. So let's focus specifically on the implications of high interest rates for your retirement. Well, for one, they tend to have a dampening effect on the economy and the stock market. And that tends to be by design. Sadly, there is no better way to combat inflation than to kill economic growth and put people out of work. When the Fed raises interest rates, they make it much more difficult for businesses to access capital, and that tends to stifle economic growth. So one thing is clear, the days of Dave Ramsey-esque 12% average annual return predictions are not likely to return anytime soon. The other downside of persistently higher interest rates is that the cost of servicing the national debt will start to go up as short-term bonds that we've sold to other countries come due. Much of that debt will have to be refinanced at today's higher interest rates, and as a result, the interest on our nation's $32 trillion of debt will begin to consume a larger and larger portion of the federal budget. And as that interest rate begins to crowd out all other expenditures, the federal government will need huge infusions of cash to meet their obligations. And that means that higher taxes in the next 10 years are all but unavoidable. Absent an increase in revenue, they'd have to cut benefits across the board for programs like Social Security by 23% starting in 2032. But higher interest rates aren't all bad news if you're planning for retirement. If you are the type of person who uses insurance-based products as a way to shield yourself from longevity risk or the likelihood that you'll run out of money before you run out of life, then you'll see a silver lining in all of this otherwise gloomy news. For example, if you're planning on using guaranteed lifetime income in the form of an annuity to cover your basic living expenses in retirement, then you'll benefit from the impact of rising interest rates. How so? Well, when interest rates go up, insurance companies invest in bonds with higher long-term payouts. This means that you can get more guaranteed lifetime income for the same amount of money. For example, let's say you have $1 million and you want to purchase an annuity that pays you guaranteed income for the rest of your life. Had you bought an annuity in 2020 at historically low interest rates, you would have gotten a guaranteed 5.3% or $53,000 per year. However, as of September of 2023, when interest rates are much higher, that same $1 million deposit would get you $78,000 of guaranteed lifetime income. Multiply that over a 30-year retirement, and that will give you an extra $750,000. That's quite the silver lining. Furthermore, if you're considering utilizing what I refer to in my best-selling book, The Power of Zero, as the life insurance retirement plan, you have another reason to celebrate: higher interest rates. If you're using the LIRP in the form of indexed universal life, then interest rates are what inform a life insurance company's options budget. And higher interest rates translate into a larger options budget, which translates into higher caps on the growth of your cash value. During past periods of low interest rates, we saw caps go as low as 7 or 8%. Now that interest rates have returned to historically normal levels, we're seeing those caps return to 11 or 12%. And that means that your rates of return will increase commensurately. In short, higher inflation and the resultant higher interest rates can act as a wet blanket on the economy and increase the cost of servicing the national debt. This could in turn force tax rates to go up sooner. And unfortunately, it looks like these higher rates will be sticking around for the foreseeable future. However, if you're looking to incorporate insurance-based financial instruments like guaranteed lifetime income annuities and the life insurance retirement plan into your retirement strategy, then higher interest rates may be just what the doctor ordered. Folks, in the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you want to learn more about how to adopt a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to DaveMcKnight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the PowerZero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn about how to become a certified PowerZero advisor, head over to powerzero.com and opt into my free 3-part video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.